The Greek crisis has now entered its final and conclusive phase. The decision by the Greek government over the weekend to call a referendum on the current set of proposals put to it by its international creditors has led to a dramatic escalation in the political and economic situation in Greece. As a result, the European Central Bank has refused to extend further emergency aid to the Greek banks, and as a result of the significant increase in withdrawal of deposits by the Greek population from the Greek banks, deposit controls are now imposed all over Greece, limiting the ability of the Greek savers to withdraw more than 60 euros per day. This means that the IMF is not likely to be paid by Greece tomorrow, so the country will go into arrears against the IMF, and therefore, effectively, it is now in the hands of the Greek population to decide the future of the country. And I think we should be under no illusions about what this referendum is about. We heard today from Europe's leaders, including Angela Merkel, François Hollande, Prime Minister Renzi of Italy, that this is indeed a vote about whether or not Greece wants to remain or not in the euro. So the stakes of this referendum on July 5th could not be higher. In the event that the referendum is a no, I think the consequences for the Greek economy will be monumental and very long-lasting. It is clear that in that situation, the European Central Bank will stop providing liquidity to the Greek banks, which would subsequently face financial collapse and permanent closure because there would be no money left to recapitalize and restructure them. So they would, in other words, never fully reopen. At the same time, I think there would be a clear and almost complete default against the euro area partners by Greece, which would mean that there would be a strong, in my opinion, political demand by the voters and taxpayers of other countries in Europe to essentially effectively deny Greek access to any of the benefits of being a member of the EU. So in other words, we would set in motion a train of events that would lead to the exit of Greece both from the European and Euro area institutions. In the event that the vote is a yes vote, I think the most likely implication would be that the current government of Greece resigned, and we would be followed either, and this would be the most optimistic scenario, by a national unity government which would quickly commit to implementing the reforms put before it, the Greek people, so that we could relatively quickly see a restoration of full liquidity support to the Greek banks by the ECB, and therefore a reopening of the Greek banking system in a matter of only, in my opinion, a few weeks. However, the perhaps more likely outcome is that the government resigns and there are new elections called in Greece, elections that may or may not result in the formation of a new government or a government different from the current government. But I think we should be clear that even in this outcome, the Greek banks are likely to remain closed for the duration of the election campaign, because I do not believe that the European Central Bank would commit to lending more money to the Greek banking system in such a period of still acute political uncertainty. So while a yes vote, in my opinion, is much more desirable and more likely than is the case of a no vote, which would indeed be quite catastrophic for Greece, we should be under no illusions that this will not necessarily lead to a rapid reopening of the banking system in Greece, and therefore that lasting damage has already been imposed on the Greek economy by the decisions of the Greek government over the last couple of days.
The crisis in Greece as of the end of June is affecting not only Greece, but also half-dozen neighboring countries where Greek banks have a very large presence. in particular in countries like Bulgaria, Macedonia, Serbia, Albania, Cyprus, and Romania, the share of banking assets in the hands of Greek banks is between 20 and 30%, quite a significant share, particularly in commercial assets, in commercial credit. The implication for this fairly large share is that should Greek banks go bankrupt in Greece, one would expect within the matter of several weeks to see also negative effects on the availability of commercial credit in this half a dozen European countries. They already have been affected by the ongoing financial crisis in the Eurozone. That means a significant negative downturn in the availability of fresh credits to small and medium-sized enterprises in these countries.
Last year, the Greek economy had started to recover from the very protracted recession. Around the summer of last year, the economy was growing at around 2% year on year, and it was expected to grow this year at close to 3%. Unfortunately, those forecasts have had to be changed, mostly due to the political uncertainty. And now, the best possible outcome for this year's growth in Greece is going to be flat growth or very likely a recession. A good way to quantify the impact of this change in forecast is that the difference between the expected growth last year and what is going to happen this year amounts to around 4 percentage points of GDP. Divided by the 11 million Greek citizens that there are, this is around €700 per person. This is basically equivalent to 1 month of pension payments for the poorest Greek citizens. It is a disaster. Unfortunately, there are downside risks to this forecast because the economic consequences of a protracted period of closed banks and capital control are likely to be quite negative. It is very easy to introduce these restrictions. It is quite difficult to remove them. In other words, the economy after the referendum, regardless of the outcome of this referendum, is going to be much weaker than it was last Friday when the referendum was announced. This is what we need to keep in mind as we try to analyze the Greek economy looking forward.